Ladies and gentlemen, welcome to another edition of In the Pit with Lobo Tigre. Our victim of the day is Kerry Knoll. He's executive chairman of Generation Mining. This is perhaps not a new, but a renewed platinum, palladium, nickel, copper, PGM play in Canada. And so it's of interest now. These commodities are all hot. Kerry, why don't you go ahead and tell us what Generation is working on, and then I've got some questions.
So we've just finished the feasibility study on our marathon project in northwestern Ontario. It's a large open pit. In fact, it's the only feasibility study that's been done on an open pit palladium project that I'm aware of in the world right now. So it's kind of unique. And the nice thing about having an open pit is that it's a lot shorter time frame to production than some of these deep underground ones that are going forward. We'll probably be in production well before them. So the project it's mainly palladium. About 58% of our revenue is expected to be palladium, but it's also got a very nice copper credit. Another 26% of the revenue will be copper, and then we've got some platinum and some gold and some silver. And the feasibility study came out showing that 13-year mine life with a palladium equivalent of about 245,000 ounces per year.
All right, well, that was an admirably pithy overview. So, okay, no nickel, copper. Got it. Actually, before we get into that, let me just ask: is this the marathon project that the company that is now Marathon Gold had formerly developed? Just curious about the history.
Correct. That is. So that project was had a feasibility study done on it in 2010, and that prompted Stillwater to make a takeover bid for Marathon PGM. It was called then. And they paid 118 million US dollars for it in that year. And they went on to develop it. They redid the feasibility study. They realized that at those palladium prices at that time, which were under $500 an ounce, that it was not an economic proposition. So they've shelved it. And eventually they got taken over by Sibanye in 2017. Sibanye also didn't really advance it too much. And eventually we bought it from Sibanye.
So that's kind of one of the questions. Why did they sell it? If I guess they weren't bullish on their own metals profile. I mean, to spend that much money and then turn around and sell it seems kind of odd. If the project actually has merit.
They bought Stillwater for $2 billion. They were buying the mine in Montana, and that's turned out to be a great acquisition for them. The development assets that came with Stillwater were all sold. If you look at Sibanye's history, Sibanye is a $15 billion company with 100,000 employees. Sibanye has not built a mine in its career. It's been around for 8 or 9 years, and it has never built one. And that's fine. They've done really well with their business plan, and they may begin building mines sometime in the future. But my point is that they sold off all their assets. And when we started negotiating with them, the price of palladium was $1,000 an ounce. And they didn't think it was going to be economic. I think it's economic. According to our feasibility study, it is economic at $1,000 an ounce, depending on what the price of copper is. But that said, it's definitely was not on their radar. A company that size and at that time, it just didn't look like it was a mine to them.
Sure. And if they
However,
sold,
they did keep.
I think the key point is if they sold all the assets, it wasn't like this one was their crappy one that they needed to get rid of. It just wasn't their profile.
Well, they also told us at the time that they did keep 20%, and they did tell us at the time that if they didn't like it, they wouldn't have bothered to keep the 20% because it's an aggravation for them. But they did think it had potential.
That is interesting. Okay, so I do have questions about the feasibility study, but before we go there, let's just talk about palladium itself. And I absolutely get that right now prices are high, and I understand that there are structural supply issues that may keep them high for a while. But you have an almost 13-year mine life, and we think about the accelerating adoption of the EVs, and I just talk me through the logic of how palladium stays high enough for this to continue to work. You got to permit, you got to raise the money, you got to build the mine, you got to pay back, and then maybe it's all gravy. But until then, we could see really big changes in that market space. So on what basis can I, as an investor, be bullish on palladium long enough for your project to work out?
Okay, well, there's a number of things going on, a number of things. So just for make sure your audience understands, about 85% of palladium is going into catalytic converters in cars. Traditionally, catalytic converters needed about 3 grams of PGMs. But higher in North America, because North America had more stringent emissions rules coming first out of California, and then a number of other states adopted them. And the car companies decided they're not going to make two different kinds of catalytic converter for different states, so they just made one. And it got adopted in Canada and Japan as well. But it didn't get adopted in Europe and China until it was announced in 2017 and I believe 18 in those two countries. And it was a 5-year rollout. So what is happening is the PGM loading in each automobile has been going up for the last 2 or 3 years, and it's got 2 or 3 more years to reach its capacity. At that same time, there's been no additional mine capacity come on. So you've had, and which is why one of the reasons you've had the price increase. The other reason the price has increased is because there was a lot of surface stockpiles. The Russian government had 5 million ounces. There was a couple of million ounces in some ETFs, and more recently there's been a lot of jewelry recycling. Palladium used to be used a lot in white gold when it was down $200 and $300 an ounce 20 years ago. And so a lot of that is being recycled because it's very valuable. It's trading at $2,600 an ounce right now. So why do we think it's going to stay up there? Well, we think it's going to stay up there for a while, for about 5 different reasons. One of which is the current increase in the loadings in the cars in China and Europe is not even finished yet. So the consumption each year is going up. Other countries like Indonesia, India, Brazil are talking about requiring these better catalytic converters in their big cities, because those big cities in those countries are extremely polluted. A lot of that pollution is coming from gasoline-powered cars, and they want less emissions in those cities. So that rollout could continue, and that could continue to increase the annual usage of palladium. As the rollout to electric cars goes, was involved in the lithium business 10 years ago, and everybody 10 years ago was saying, well, by 2020, we're going to have 20% of our cars are going to be, new car sales are going to be electric. Well, we're up to 2.5% worldwide right now. So the rollout has been much slower. Some people think that it's going to be 20% in 2025. Some people think it's going to be 20% in 2030. I don't have an opinion on it. I think the rollout is going to be generally slower because of lack of metals for electric cars. There's not enough lithium in production. There's not enough nickel. There's not enough cobalt. The rollout will happen. Don't get me wrong. I think it's going to happen, and I think it's a good thing that it's going to happen. But it's going to be slower. What is happening, though, and the rollout is much bigger, is hybrid cars. And if you know anything about a hybrid car, it doesn't burn as hot as a regular gasoline engine. Therefore, it needs higher palladium loading than a regular gas car. If you hear about thefts of catalytic converters from cars, you may have heard about them. There's a theft rings going on all over the US and around the world, and they're targeting the Priuses because the Priuses have the richest palladium loadings in the catalytic converters. So as hybrid cars sales are much higher than electric car sales, and as people are greening up their what they drive, we believe for the next 10 years, and we've got proof from an analyst that we deal with who deals with metal supply issues for the car companies. They believe that hybrids will be outselling electric cars for the next 10 years. So that will require, again, more palladium. Another thing that's happening is more and more around the world, I believe 38 of the states in the United States require cars that are a certain age, usually 5 years or more, to have an emissions test every couple of years. When they do these tests, if the palladium has degraded, they got to go out and buy a new catalytic converter. So there's the cars that are being sold today that are going to be on the road for 20 years, they will be replacing catalytic converters starting in about 8 or 9 years from now, the cars that are brand new today. So that's going to need more palladium.
Will people really do that? I've never heard of anybody replacing the anecdotally, I've never heard of people replacing a catalytic converter. You talk about a $1,300 piece or whatever it is now. I think a lot of people say, oh, I'll just get a new car.
Well, I just know then the car has to come off the road, and then they buy a new car, and then that's buying another catalytic converter that way. I mean, whichever way they do it, a new catalytic converter is made, because if that car is not drivable, um, something's got to give. But if it's an 8-year-old car, they're probably not going to junk it. They're mostly the catalytic converters do last about a dozen years, but there's so in the life of a car, usually there's a one-time replacement in the states that require that. They used to require it in Canada, they don't anymore, but that could come back. But other places in the world, in Europe, they're talking about starting to have those emissions tests as well. I'm just saying that's one of many different reasons. But I think the biggest reason is going to be the hybrid cars and the rollout in other countries like Brazil. If you've ever been to Sao Paulo, it's extremely polluted. If you've been to any of the big cities in India, you know how long India has announced a rollout, but they haven't been enforcing it, so it's not happened yet. But that again could take up a lot of palladium. And then you've got our mine cycle. So Drew Anwell, our chief operating officer, who's a very wise guy when it comes to planning, looked at that whole cycle and said, okay, we've got a high grade section where high grade palladium, and then we've got other sections that are higher grade copper. Electric cars are going to need a lot of copper. There's not enough, by the way, there's not enough copper in the world for the whole world to go electric cars right now. But so what we see happening is electric cars get more popular as the copper price is going to go up. So we have designed the mine, and luckily the mine, the ore body allows us to do it, partly by stockpiling ore for the future. We have designed the mine so that the first 5 years get about 70% of the palladium out. So we're getting it out at the start, the high grade palladium. Then we transition to the higher grade copper for the second half. So if electric cars by 2030 are rolling out as we expect them to be, copper price is going to go up. And if copper price is going to go up, it's going to become more of a copper mine than a palladium mine. Our copper grade, by the way, is very similar to the copper grade of some of the big open pits in British Columbia, and yet they don't have any byproducts to speak of. Copper is only a byproduct for us, and yet it's 0.2%. So at a $4 or $5 copper price, this is a copper mine.
Sorry, what is the copper grade?
0.2%.
Okay.
So a fifth of a percent. And that's pretty much the grade of like the Highland Valleys and the some of the big copper mines out in BC. Now they're bigger mines,
but it's not high grade copper. But if you've already got the mine built and you've got credits from gold and other metals,
you've got 4 other metals.
I can see it. Well, that's actually a really interesting answer. Palladium up front, copper on the tail end, on an already operating mine. That I do get that. That makes sense. But so the key question then. Go ahead.
One other thing. We have about 50,000 ounces of platinum also as a byproduct a year. Platinum is a necessary metal for green hydrogen. So all these countries are holding conferences and talking about the world turning to green hydrogen, which I think will happen, but I think it's a long ways out. But nevertheless, even in right now, Honda and Toyota are selling hydrogen cars. Hydrogen car needs a full ounce of platinum. There's only 6 million ounces mined every year in the world. So if you look at where's it all going to come from? There's 75 million cars sold every year and 6 million ounces of platinum. So the world can't go to hydrogen with the current technology. So again, we see if there is a rollout of hydrogen fuel cells, platinum is going to become a great byproduct for us as well. So we've got this whole suite of metals that is different aspects of the green economy.
All right. So to wrap up this part of the questioning, then let's just, what is a realistic time frame? I know it's putting the cart before the horse because I want to talk about the feasibility study, but if palladium has, say, 5 years in the sun, can you actually get your palladium to market within 5 years? You still have to permit it. You need to raise $500 million. You need to build the mine.
Yep. So we are targeting permitting to take another year from today, and that's a realistic timeline, we think. The process that we're going through is called the joint panel review between the provincial and the federal governments, and they've appointed the panel. We're submitting the documents to them. Once we submit the last documents to them, which we're hoping is the first week of April, they have 276 days, and that's a legislated number of days for them to complete their panel review. Then they make a recommendation to the government, both federal and provincial, and we're assuming it's going to be good. This is a fairly benign mine. It doesn't leak acid, or we don't think there's any damage to the environment on this. So therefore, we expect to get our permits in that time. So if we do in the second quarter of next year, we could then begin construction. In the meantime, this year we're going to be doing all of the detailed engineering and arranging the financing. And we've got a lot of banks and different groups hovering around, wanting to work with us on the financing. And we think it used to be, a mine was debt and equity. That's all you had. Well, now you've got streaming. We've got a bunch of byproducts that we could stream. We've got 2 private equity companies are wanting to get involved. The smelters are talking about helping them with the financing in return for an offtake agreement. So we've got all these different avenues that we've got to sift through, but we do have the period of time while we're waiting for our permits to arrange that financing. So we want to do all that. So if we can hit the ground running next summer, which we expect to, the feasibility study estimated it's a 20-month time. Drew Anwell was involved in building Detour Lake, which was much bigger, and he did that in 18 months. So, but nevertheless, that would indicate that we could turn on the mill at the end of 23, call it 2024, with the first full year of production being 2025. That's our timeline. We have done everything that we have accomplished so far in this company in the time frame that we said we were going to do it. We only acquired this project in July of 2019. We had a PEA done within 6 months, along with a brand new resource. We had a feasibility study done 1 year later.
All right, 2025. Okay, and you've already sort of answered the other question I would go with. But if there is a copper tail of increasing importance going forward, then I can see that. All right, so let's talk about the feasibility study, and the number, the primary number is the 1725 price assumption. I could see that over a few years, but over your mine construction, permitting, construction, and operation, that's a 15-year time horizon. It seems pretty aggressive to me. 1725. How do you justify that over 15 years?
Well, I'll say a couple of things. First of all, that's a consensus of 15 banks. That number, it's not our. We didn't come up with the number ourselves. Some of these banks were as low as $1,000 long term. That was the lowest, and some of them were $2,400 long term. So it's an average, and it wasn't a cherry-picked average. It was, we went to another group who monitors these things and said, what is your current? And that was the number that they came back with. So the 1725 comes from that. I'll also point out that when we came out with a feasibility study, palladium was trading at $24.50. So 1725 is $700 lower. Show me a gold company that was willing to put out a feasibility study that's $700 lower. They don't know what the gold price is going to be 10 years from now, but they're still putting out feasibility studies with gold at $1,500.
Well, yeah, but that's different. There's not the same supply crunch side, and it used to be that you would have your 3-year trailing average was the conservative number. But if you use the 3-year trailing on palladium, that would not be conservative. That would be the opposite of conservative. So I think it's a little bit different, but I do get the point, and I do get the industry consensus. I just all right. We don't need to argue philosophy.
There's only 2 other palladium. Okay. All right. Fair enough.
All right. A key point then, going deeper a little bit into that, is the metallurgy and the recoveries. The values on the different metals. I was wondering if there's an example of another mine somewhere, I know not open pit, but that has the same mineral type with the same collection of metals in it that gives you confidence that your recoveries, across that variety of metals, I was impressed by how high the recoveries. The worst are in the mid-70s. For trace amounts of smaller metals, those seem like really high recoveries. And I'm wondering about the level of metallurgy, presumably feasibility level, but also I'd have more confidence if you could say, look, such and such mine has the same collection of metals and they're able to recover similarly. Is there an example like that, or what's your basis of confidence
Absolutely. The only other palladium mine in Canada is called Lac des Îles. It's now owned by the South African company Impala. They paid $1 billion for it. It has got a very similar ore to ours, and they're getting very similar recoveries. The only difference between their ore and ours is they have a nickel credit as well, and we don't have any. But that said, they've got copper, they've got gold, they've got platinum, all as byproduct credits. So, and they're getting similar recoveries. Steve Haggerty, who we brought in to run the metallurgy program in our feasibility study, Steve was chief metallurgist and then later on vice president of optimization for Barrick worldwide, a very, very senior mining position. He looked at our flow sheet that was in our PEA, which was based on work done by previous owners, and said, this ain't going to work, guys. So we need to go back to the lab. And luckily, what has happened is he went to the different, there's been a few big technological improvements in the last 10 years in this type of recovery. There's been something called the flotation reactor, which was invented in 2009 and commercialized in 2014. It's now in more than 200 mines around the world, including just installed in Copper Mountain in BC. And these are companies ripping out their old flotation devices and putting these in because they use less power, they're cheaper to operate, and they have better recoveries. The other thing that has changed is the companies that manufacture the flocculants, the chemicals that you put in to help float off the metals, those have been improving. So we went to those companies, Steve went to those companies and said, you know, what are you selling to the South Africans? What are you selling to the Russians for this recovery? And they gave us a bunch of samples. We went to SGS, international metallurgical firm. We did a bench scale test and we came back with the numbers. And those numbers were sufficient for the feasibility study, but it weren't sufficient for us. We decided to go a step further and do a pilot plant, which we did last fall. We actually took samples of rock from the mine, did a pilot plant at SGS as well, and confirmed those recoveries.
So beyond bench to pilot, like how many tons did you put through that? How big was the sample?
It wasn't huge. It was you know, I can't recall offhand, maybe 6 tons. But it was a continuous process, and we showed that it worked.
Okay. So
another thing that it showed, which is quite interesting, is in those early years when we're mining the high grade palladium, in the concentrate we're getting a couple of grams of rhodium. Rhodium is not in our reserves. It doesn't exist because it was never assayed. For all the work that was done on this project, 160,000 meters of drilling, never assayed for rhodium. So there will never be rhodium in our reserves. But we know that this 2.4 grams was showing up in the concentrate. Well, rhodium is trading at what is it?
It went through the roof.
$900 a gram. We have one of the smelters we're dealing with has offered to pay us 50% of the rhodium that we get. Now that's only in the first two or 3 years of when we're mining the high grade, but nevertheless, that could be $90 million per year additional, just that 50%. So if rhodium stays where it is, I don't think rhodium will, but nevertheless, people keep asking us if we have any rhodium, and it only shows up in the concentrate, not in the reserves.
Right, but in theory, you could go back and reassay, you know, the other half of the core, and if you thought you knew where to look for that rhodium, you could try to define it, but you don't think there's enough to be worthwhile doing that?
You know, rhodium is extremely hard to assay for accurately. You can assay if you've got a couple of grams like we do in the concentrate, but that's probably going to be a 20th of a gram in the core, and to try to get an accurate number on that, no, you can't even get an accurate number on a 20th of a gram of gold, and rhodium's a lot harder to assay for. So no, that would be, we know it's there. We know that it's we only expect it to really be payable in the first 2 or 3 years of the mine life when we're mining the high grade. So there's no real point. We'll get paid for it or not.
Okay. I was also wondering not just about your metals prices, but your energy prices. And I know that one of your advantages is that you're near infrastructure, so there's grid power nearby. But again, looking out over 15 years, you know, how stable are those price assumptions, and particularly the diesel price assumption? You know, how do we, how do we know what diesel prices are going to be 15 years from now for your trucks?
So you have to make an estimate. And the people doing our feasibility studies, G Mining and Ausenco, well, Ausenco was more of the plant, which doesn't use diesel. So G Mining, they've been doing feasibility studies for decades. They have to come up with some long-term assumptions, and if anything, I believe diesel prices are going to come down over time, because as say mines and other things get more electric, there will be excess capacity. So I think the diesel price that they used is again, we used a consensus pricing. We went around and asked a lot of people and came up with the best guess we could.
All right. So I guess push comes to shove, the sensitivity table is something that I would call the audience's attention to, that you do have a $1,000 palladium price on the low end and the $2,500 on the up end. So even at $1,000 an ounce palladium, it's still 14.8% IRR, and there is some comfort there. But I still can't kind of get it out of my mind that it wasn't that long ago that palladium was 500, and if things go farther south. But then you have your other metal credits, which brings you back to the metallurgy again and getting them all out. So
I honestly believe that if palladium goes down below $1,000, it's because electric cars are ramping up like crazy, and I think we're going to see a $5 or $6 copper price. So I think that it's got to be one or the other. People are not going to stop driving. So if it's electric cars, they need the copper. They can't get around it. They need it for the engines. They need it for the wiring. An electric car uses 180 pounds of copper. A regular car uses 40. So you've got 4.5 times the copper content. And where's that going to come from? Grades of the copper mines around the world are declining right now. And the few new copper mines that are being built are not enough to make up for those declining grades. So if you've got a situation on the one hand where consumption is increasing, and on the other hand where the grades and output is declining, you're going to see a higher price.
All right, still point two, but yeah, if you've already got the mine built, I get it. So I was going to ask where you're going to get $500 million to build this thing, $500 million US. You've addressed that already, but can you give us your sort of corporate strategy or priority? Are you leaning towards a stream, or?
We're looking at, first of all, figuring out how much debt this can carry, and we're going through that right now with some banks that are talking about loaning us the money. Then the next one is to look at how much is left. So let's say, for example, this can take 65% debt. Maybe a bit aggressive, but so that's 35%. So then you're down to call it $200 million. Well, let's say we can do a $100 million stream. And let's say that we can go to the smelters and say, okay, can you advance us $50 million on future concentrate sales? Well, then we're down to $50 million in equity. So that's one scenario. That I'm not saying that's going to be it. This is all going to play out one at a time. We're going to start with the debt, then we're going to look at the possibility of a stream. Then we're going to talk to the smelters. We've got term sheets from 2 smelters on financing. So it's real. Our concentrate is considered quite good, and they know that they can mix it with crappy concentrates from other mines and still have a concentrate that they can work with, and they buy these crappy concentrates very cheaply. So that's why ours is considered a valuable concentrate. So we've got all these different options, and then we could always possibly sell a small part of the mine to a private equity company. And as I said, we've had a couple of them hovering around as well. So there's all these different possibilities.
Have you been approached by any of the royalty companies for not just streams, but royalties?
Yes, one of the big ones.
No need to discuss that. But I guess if you can get away without a royalty, why encumber it?
That's right. We would prefer not to. So we're going to see what the different people offer us as we go through the pace. One of the big advantages we have on the financing on the debt side is that at that $17.25 and $3.20 copper, we have a 2.3 year payback. If you look at some of our competitors, for example, there's only two other companies that have feasibility studies on palladium mines. One is Ivanhoe, which is hard to compare because it's more of a copper company, and one is called Platinum Group Metals that has a really great deposit down in South Africa, but it's deep. So they have a I believe it's a 7-year payback. Well, we've got 2.3 years, and at spot prices today, our payback is a year and a half.
That would even meet Rick Rule's criteria of 2 years or less payback.
Yeah.
All right. So what's next? You've just come out with this feasibility study. You're talking with your funders. You're advancing the permitting. What are the deliverables that a potential shareholder today could look forward to in the remainder of this year?
Well, we're talking about with a lot of companies about a strategic investment. We're talking about other mining companies here. We need to raise some money. We've got about $11 million Canadian in the bank right now. We're going to need more by the end of this year. So probably in the spring or the summer, where we will be doing a financing. And one of the possibilities is having a strategic partner come in. And I know that's always been that's been very positive for most companies' share prices, because if another mining company was to make a large investment in us, obviously they would have done their due diligence, and it would give it another level of confidence. So that's a possibility coming up. We're drilling right now. We hit some high grade palladium intercepts last fall down below the open pit. This would be for underground mining, much higher grade than the Lac des Îles mine, which is an underground mining also in Canada. So we're following up that. We're drilling that right now. We'll be drilling through the entire summer as well, so there will be drilling results coming out. We've got we'll have announcements.
Before you move on, Kerry, before you move on for that, let me ask you. I noticed that slide in the last press release on the drill results, and you see that purple band going off the side of the pit and keeping going below, and you see those hits down there, but. High grade is only relatively high grade compared to the pit. It doesn't look like high grade for underground mining. So,
well, the Lac des Îles mine is which Impala paid $1 billion for, and only does about 200,000 ounces a year, and that was when palladium was at $1,500. That their grade is 2.4 grams underground.
Palladium equivalent.
Palladium equivalent. Ours is. We were getting 6 and 8 grams in different spots. And so, again, if the palladium price went down a lot, no, it probably wouldn't be a mine. But what the idea would be is that we could ramp down to these areas and supplement maybe 1,000 or 2,000 tons a day of much higher grade ore to the open pit grade, which is around a gram, or a little over a gram palladium equivalent. So.
All right. Okay. So. I guess we'll just have to see if there's an underground resource in the not too distant future, because I'm looking at different drill results, and there's a spot here, but then there's Sorry, go ahead.
We're also checking for we found a few boulders on the property that are super high grade. We're talking a couple of 100 grams and 9% copper. And they didn't come from the deposits because the mineralogy is different. So we're looking for the sources of those boulders, which is another possibility of we may find a small or even a large, much higher grade deposit. And these are there's geological reasons why these would exist, but are we going to be able to find one? I can't answer.
There's a long rabbit hole. We don't have to go down there, but presumably you know which direction the ice moved and where to begin to look for the source of those boulders. But let's just go then to so your exploration budget for this year. We're in the boring engineering phase, the detailed engineering. We're waiting for permits. We're waiting for financing. So you're going to explore, and how much money do you plan to spend? And
$3 million.
$3 million. And that will be split between continuing the underground extensions and regional? About 50-50, or where's the focus?
We just had a meeting just before this meeting, and we haven't finalized all the drill targets yet.
All right, but you'll be looking for both. Okay.
Probably 60% to the deeper stuff and 40% regional.
Okay. Any other news or deliverables while we're waiting for the major milestones going forward?
I don't think there will be too much. I just think that we'll be announcing, various advances in the permitting. Our permitting is our biggest bottleneck. So as people see that we're going to be getting through that, fortunately for us, the previous owner, Stillwater, did a lot of very, very good work on the permitting, and we were able to use that work just by simply updating it, and that saved us 2 years. Because normally this permitting process would take around 4 years, and they were 2 years into it. So that was really, really useful for us. So we think we're going to get our permits, and I think when people see the permits are on the horizon, when they see that we've got a strategic partner or that we've got some financing arranged, they'll start to think that this is real. The typical gold company at this stage, without any permits, tends to trade around 50% or more of their price to net present value. We're trading at the long-term consensus prices at about 20%.
Yeah, I noticed that the NPV at $1 billion, and your market cap at less than 200 million that I saw last. Okay, so but you're not scraping the bottom of the barrel. So
it's under 100 million. US.
Under 100 million, was it? Okay, all right. So you're not. You said you had 11 million in the bank, so you're not scraping the bottom of the barrel. Just sort of putting my investor hat on here. If you did do a financing, or if you had a buy-in from one of the majors, then that would cash you up. You wouldn't need any retail participation in that at all, or some of these other things. So, are you looking to include a retail component? I mean, should the people out there who like private placements be looking forward to some possibility of a seat at the table here, or is that don't hold your breath?
That's something that we probably didn't do right in the past. Getting we have very, very few funds that are shareholders of us. We've got some very smart, wealthy people, like Eric Sprott's a big shareholder, Lucas Lundine's a large shareholder, Osisco, the Osisco Group is a large shareholder. They participated in every one of our financings. But we have not gone around and marketed this to the funds, because every time we've gone to the market to do a financing, it's sold out instantly, and we've never gotten a chance to really market it. And a lot of these funds want to get out. They only want to participate when there's a financing,
sure,
with a share and hopefully a half a warrant. And so we only have about 5 funds own our stock. So we do want to get out there and market to them, and so yes. The answer is that we should do that, and we should get some more retail in here as well.
All right. Well, we'll keep an ear out for that. All right. Well, Kerry, you've been a very good sport with a bunch of questions I've been scratching my head about. I think I understand the idea, and I'm actually favorably impressed by your palladium copper pivot there. That I hadn't really seen the story that way before. That's interesting to me. But the one question I always have to ask everybody is, if you want me to put my own hard-earned money into this, I have to ask, how much of your own have you put in? How much skin in the game do you have, Kerry?
Okay, personally, I own 3 million shares. When we started this company, there were no founders' shares. We put in money at the same price as the other investors at every step of the way. So we did our first financing at 10 cents a couple of years ago, a little over 2 years ago. No, it's 3 years ago now. We did a second financing at 28 cents. The third financing was at 52 cents. Fourth financing was at 77 cents. Other than the 77-cent round, which was oversubscribed before, well, what happened was Eric Sprott called us up and said, I want to do this. So I didn't get even a chance to participate in that one, but I participated in all the other ones, and so did a lot of other management. We have we own 6.5% of the stock, and that is all bought and paid for. Again, no founder stock in this company. I don't believe in founder stock. I see a lot of these companies start up and they had a little shell and they did them, 10 million shares at a penny. We didn't do that. We have participated at the same price as everybody else. And I don't know the exact amount my 3 million shares have cost, but I would guess it would be somewhere, I have somewhere probably close to $1 million in the company.
Okay. Well, that's an excellent answer. I'm happy to hear it. I appreciate the update, the overview. Keep us posted, and good luck with it.
Okay, well, thanks a lot for your time and for some pretty good questions.
Thank you for watching this edition of In the Pit with Lobo Tigre. If you enjoyed or found value in what you just saw, and you're watching this on any sort of social media, please do hit the like button and the share link. Send this on to anybody you think might be interested. That helps us out a lot. If you're watching this on YouTube, please do hit the subscribe button as well. The number of subscribers helps us get more valuable content to you as well. On the subject of subscribing, I'll quickly say that if you're not a subscriber to our free weekly Speculators Digest, I encourage you to sign up. I promise if you do, we will not send you a flood of daily advertisements. You get one free weekly digest with original research not published anywhere else. Check it out at independentspeculator.com. Thank you and have a great day.